Okay, well, thank you, Kate. Again, great to see a lot of faces and hear some people too. Um, wow, all these years together, sometimes the connection between the stock market and the real economy is quite clear. The aftermath of 9/11, the first few weeks of the pandemic, the housing crisis, pretty much both the stock market and the real economy both went off a cliff simultaneously. And of course, there's good times too. The recovery from the pandemic and really all those other crises, stocks in the real economy moved upwards, and that seems to be quite logical. But what's really happened over these past 6 months shows that occasionally that link can be exceedingly difficult to find. And indeed, in this case, might not exist at all. Because as we've seen, the stock market has been in a steady decline this year, even while most statistics from the real economy, most particularly unemployment and inflation, signify that things are very strong. Now, I do recognize that when people are going to look at these top line economic statistics, the gross domestic product, they're actually quite likely to show a small decline for the first 2 quarters of this year. But there's no way we're in a recession, not with unemployment at 3.5%. So it could be a tiny statistical anomaly, but we're not in a recession now. But really, of course, what we try to do with these is to think ahead and trying to forecast or pretend that we're forecasting. Um, and what I suggest we do is similar to what we've done on a lot of these prior calls, which is basically try to put ourselves into the shoes of policymakers, basically the Federal Reserve and some, the other central banks, review the data and try to predict what they're likely to do and what the effects of those actions would be. So as I alluded to, the data really now show an economy basically at full employment. You know, maybe with a few exceptions, but if you want a job right now, you can pretty much find one. So full employment with elevated inflation, to put it mildly, and high inflation expectations, which are also very important. Anxiety over inflation and recession are each very high. And the political environment is actually stoking those anxieties and making them more pronounced. And so to date, the increase in interest rates that we've seen and this modest monetary tightening, it's shown a small bit of improvement on the inflation expectations while simultaneously pushing fears of recession front and center. So with the fight against inflation, the number one goal articulated by the Fed, and so little actually having been accomplished, and in the current political climate, certainly expect significant further interest rate increases, monetary tightening, until inflationary expectations and the actual data respond. So to reach the professed goal of 2% inflation, our opinion will necessitate tightening not yet appreciated by the markets. And why am I saying that? Because basically kind of tying in with what we've talked about some of the prior calls, inflation is likely to be pretty sticky because there's numerous forces applying upward pressure that didn't exist years ago. And just to recap some of them again, housing, the largest component of the consumer price index, up 6% in this year. And there's really not really much thought that that's going to slack off. So that's the major reason. We also have this kind of slow motion rollback of globalization, an outcome of the pandemic, and also some of the political leaders the world has had lately. Wage pressure, the transition to the green economy, the energy transition. And there's still some possible ongoing supply issues caused by zero COVID policies throughout the world, especially obviously China, or other capacity constraints. So to get inflation from where it is now from 9% down to 2%, that's probably going to require too severe a set of actions. So what I'm kind of thinking is that once inflation gets to be settling or close to 3 or 4%, they're just going to declare victory and call off the emergency measures. So that's fine. Unfortunately, I think even to get to 3% is going to require an increase in unemployment and a significant economic pullback that's maybe not being fully anticipated right now, especially in the stock market. I mean, there are some positives. I mentioned some of the negatives that will be pushing inflation up, but there are some positives that will probably help out in this path to victory, this 3 or 4% inflation area. Oil prices are tumbling. Of course, they're tumbling because everyone thinks we're going to have a recession very soon, and Europe and Japan are already in one. The dollar's been very strong. That keeps down the price of imports, which is obviously connected to the oil story. So anyway, I'm keeping that same prediction that I made on the last call that we're going to have a recession later this year. It could mean further declines in stocks, although again, given the magnitude of the declines have occurred so far, that's a tricky call. But also consistent with what our prior stance. The sectors that are most vulnerable are those that have been reliant on cheap money. Same story. The private equities, the IPOs, the Bitcoins, the more speculative investments, they're vulnerable. And should the Fed be truly sincere about trying to get us to 2% very quickly, the overall market looks vulnerable too. Flip side to this, and I might be trying to grasp at positives, but I think this is a legitimate one, is that recessions are, in most cases, good for bonds. And assuming the inflationary expectations do get under control and begin to drop, bond prices can certainly rise. So that's my most really positive takeaway from this forecast, is that inflation is likely to come down. That'll support bond prices and also reestablish the negative correlation between the economy and the stock market as opposed to bond prices. And that's really good news for diversified investors, particularly retirees who like to have some comfort and some stability in their portfolio. This idea that stocks and bonds move in the opposite direction, that'll be very good news should that happen later this year, which I expect it will. Obviously, potential negatives out there. The most scary, but maybe least likely, is that the Fed just gives up and says, "Well, never mind," or else just kind of prematurely declares victory against inflation and lets it become runaway again. That's a pretty disastrous scenario that, fortunately, is pretty unlikely at this point. Another more realistic negative scenario is this insistence that we must get inflation down to 2% yesterday. And that really would incur a pretty severe economic outcome, again, not really being anticipated. So that's certainly a risk factor from what we hear today and see in the press. And making things particularly difficult for investors at this point, as I mentioned, like right off the top, just this breakdown of the link between equity prices and what's going on in the real economy as we sit here. And this state of affairs, again, very unusual, and it does argue against taking bold stances one way or the other, since stock market levels seem pretty detached from economic reality right now. And especially when you start talking about individual companies and sectors, that link becomes very difficult to locate. So that was kind of really my big thoughts, which again, the forecast for the rest of this year, not super positive, except the fact that diversified investors would see a little bit smoother ride because we might have the negative link between stocks and bonds again, which we've been lacking these past 6 months. One of our clients was very generous enough to send me a question, so I thought I just would answer that now, and then of course see what if there's other things that are on people's minds. So he basically was wondering, what about a a stock market crash, and kind of, are we in one now? And how does it compare maybe to other ones? And particularly the one he mentioned was 1929, which I wasn't quite around for that one, but I've read a little bit about that one. So I guess some of the similarities maybe between now and that most disastrous of all market crashes, the giddiness in the years leading up to it. Certainly the 1920s were a real go-go period. Everyone was wild. The stories about people getting stock tips from the taxi drivers and all that kind of thing. Well, we've seen something like that over the past couple of years with chat boards and maybe not taxi drivers, but maybe 17-year-olds giving us stock tips, things like that. Some of this wild speculation that's happened recently, markets getting very, very expensive, and politics kind of in a state of paralysis, which didn't happen right away with Hoover as president, but once things fell apart, the politics fell apart too until the 1932 election. Fortunately, I think plenty of differences between now and then. We have an FDIC now. We have our bank deposits insured. That was really maybe the major catalyst that caused the stock market crash to become a national catastrophe. Was the lines in front of banks and things like that. That's not going to happen now. The situation of the banks is much stronger, even obviously than it was then, but much stronger than it was in 2006 and 7. The regulatory regime is much tightened, and the prior administration didn't really break that down very much. We have learned a lot of lessons about how to deal with economic crises now versus then. One final difference between the 1930s and then is what they thought the remedy would be in the 1930s was to increase interest rates, to force bad companies out of business and let the strong survive. And that was wrong, 180 degrees wrong. And I think that lesson has been learned. And so each crisis is different, each market decline is different, but the elements that led up to that cascade of the stock market decline turning into the Great Depression, that's not really the current state of affairs, thank goodness. So with that, I will, and with Kate's help, of course, see if anybody has any questions out there, and I'll give it a shot.
All right, so anybody who has logged in, you can unmute yourself on your, typically at the bottom of your screen in the lower left-hand corner. And if you called in, you can unmute yourself by hitting *6.
Okay, hi, it's Carolyn and Jenny.
Hi.
Hi there. I wanted to ask, in the market that we're seeing right now and maybe for the next year, are there certain sectors that you feel are going to do better given the current environment than others?
Well, some of them have, some of the things have already happened. So I know I'm looking through the rearview mirror a little bit, but if the recessionary scenario develops, then you might think that things like the basic consumer goods that people are going to buy no matter what, that they'll be fine, better than otherwise. In general, banks can do well, assuming the economy doesn't go off a cliff. If interest rates go up because the mortgage rates go up, they make more money. The things like healthcare and pharmaceuticals, they're, I don't want to say recession proof, but if we need our medicine, we need our medicine, and that other things will get cut first. The things that would be more vulnerable, I guess, would just be the purely discretionary kind of expenses. I would say travel, but maybe there's so much pent up, revenge spending
Right.
that everyone wants to do. But maybe things like high-end housing or luxury items, you know, maybe Tiffany's would be a little bit more vulnerable than Walmart.
Mhm.
But it's hard to say. I mean, I want to, because I know I'm predicting a little bit what's already happened,
Right.
but some of those things have already happened. But should things take an unexpectedly bad turn, you could see something like that continuing.
Mhm.
Thanks.
Thank you, Nate.
Nate, looked like we have a question in the chat box.
Okay.
Do you see that, or do you want me to
don't
read it? Okay, so it says, are you anticipating shifting investments more heavily to bonds or bond funds?
I don't know if it was an either or, well, I mean, I think in general, individual bonds are pretty tricky unless they're treasuries, because just the risk of buying one or two or even five corporate bonds outweighs the benefit from avoiding the expense fee from a bond fund. But I think in general, many of our clients, again, maybe leaning a little bit more toward the retirees, have had more in cash than they normally would, as we've been kind of underweighting bonds a little bit. And we're kind of tapering that down for most people these days, just because, well, interest rates have come up. I know the money market funds are paying more, but at least the bonds are more attractive than they were a couple years ago, which was maybe at the worst of the pandemic was the worst time to be buying bonds. And now things have, gotten better, but we still have to, take a deep breath and say, well, that things could develop well for bonds, but we also have 9% inflation and bonds yielding 3%, the government bonds. So better than it was, but let's hope for some better times for a more attractive environment, as things are still pretty out of control. As I guess, that's just the way the world is right now, that the people that are setting the price of bonds in the markets are manipulated by the government, are optimistic that inflation is going to go away. Whether it's going to go all the way down to 2% for 10 years, which will make these treasury bonds a good buy, I am a little skeptical on that.
Thanks. All right, we have another question in the chat box. Do you have any comment on the proposed ideas of allowing cryptocurrencies to act as banks?
Well, yeah, I mean, let's hope that that would come along with that would be regulation, which I don't want to get too deep in the woods, but there somehow or another crypto lobbyists are incredibly effective, and they're managing, it would appear, to get their exchanges away from the purview of the SEC, which is always a recipe for disaster. I'm sorry. We're regulated by the SEC. Anytime that things fall through the cracks and aren't regulated by the SEC anymore, things become a catastrophe. We get into these self-regulated bodies, and it's just a disaster. And I don't know, I guess things have developed so much over the past couple of weeks as crypto fund after crypto fund after crypto exchange goes bankrupt, and the creditors are basically being left with virtually nothing. So I'm not quite sure how that's going to play out, but these exchanges that present themselves as if the deposits are safe in any way are wrong and misleading, because they're not guaranteed by anything. Sometimes they say they're guaranteed by these stable coins, which are not stable and they're not coins. They're just artificial, usually assemblies of other Bitcoin or crypto related investments that are not safe either. So I guess we'll see, because a couple of weeks ago it seemed that that crypto was going to be regulated in a way that was very favorable for themselves. But I don't know, a lot has happened over the past couple of weeks, or really over the past 6 months, with the price of most cryptocurrencies down by roughly 2/3. So definitely I think some of the shine has gone off a little bit, although who knows, tomorrow they could start going back up again. But the exchanges themselves, non-regulated and incredibly risky, and nothing is guaranteed.
Thank you. Does anyone else have a question? Feel free to unmute yourself. Go ahead, Carolyn and Ginny.
Where do you, and if I missed a little bit at the beginning, I'm sorry, Carolyn was here. I came in a little bit late, but where do you see inflation like by mid-October? Like a quarter out, are we looking at 8%, 8.5? How much progress do you think we can make in 3 months on the inflation?
Well, it's a little tricky because the top line number includes gas and food, and they've really been exploding higher. So it seems like both of those are going to come down quite a bit in the next couple of months. So that might make the top line number look quite a bit better. It's really the underlying rate that's scarier to me. So that's running around 5.5% and 6%. That might be about the same in a few months, because I don't know how they're going to slow down the inflation that comes from housing prices and some of these other things, or even food. That's just going to take a while. And to, I'm not rooting for unemployment, but really we need unemployment to take some of the pressure off of wages. And that's not, as of last month, I mean, again, the job creation rate was spectacular, and that's really pushing wages up too much at an unsustainable rate right now. So I do think in a few months, maybe the inflation rate will look like it's in the 5 to 6% area, which is still too high, but moving in the right area.
Right.
And of course, even trying to predict gas prices or food prices is insane in this world, because, a lot has been dependent on what, a guy in Moscow does. And that's been pretty unfortunate, to put it mildly.
Exactly.
So things could get worse in that area. I mean, they're cutting off the supply of gas to Germany, and, so definitely some, very difficult to predict, is all I'm trying to say. But,
Yep.
with all these recession fears that have popped up, certainly the price of gasoline will be a lot lower in August than it has been in June and July. And that'll make the top line number look a little better, which is good, because people can calm down a little bit.
Right. Thank you.
Sure, thanks.
Any other questions that folks would like to ask? Feel free to use the chat box or to unmute yourself.
Hi, this is Andrew Bergen.
Hi, Andy.
Hey, Andrew.
Nate, I was wondering, do you foresee excessive retreats of the market if we have these large interest rate increases? I missed the first 5 minutes, so you may have talked about that then. I'll mute myself.
Well, I would say no, because, I mean, other than what, if we talk about going forward, I would say no, because I have to admit, I would have thought that when inflation came in at over 9%, which was higher than expected, even what was expected was bad enough, and that all of a sudden, instead of a half, that the Fed would increase rates by a half or 3/4 at the next meeting, it became 3/4 or probably 1. And I don't want to say the stock market didn't care, but it didn't care. It barely moved. And bond prices actually gained. So, it just seems like there's a lot of, I don't know what the right word is, but I guess it's a lot of these interest rate increases, whether they happen all tomorrow or within the state of, within 2022, are already anticipated. And the stock prices have adjusted for all those things that are going to happen. And that's wow, that's good, I guess, if things don't, if things are fine from here. I guess what's really important is if, the actions show results. So, Jeannie's question about, well, are we going to start to see any positive news? And should that happen, which I do think is likely, uh, you know, in a few months, let's say, then I think, oh, that's sort of what the market is anticipating, and that there won't be these further surprises or, oh, we've got to, increase rates another 1%, another 1%. That would be pretty bad. But certainly the market expectation, and I guess mine too, is that things can cool off on the price front. One, because of the interest rate increases, and two, just because of the general, some of the slowdown in the oil prices and food prices that have been caused to some extent by these sort of one-off events. And even as widely anticipated, that China comes up with a way by the end of this year to walk their way back from the zero COVID, which has caused so many of the supply crises, that'll kind of go away too. Some of the other things have gone away. The shortage of electronics for autos, that's gone away, and so forth and so on. So, assuming that we've seen the worst of inflation and that the interest rate increases that are in the works, that there's no unpleasant surprises going forward, then I think things can be okay, I guess, based on what I've seen over the past week. Because I'm, just for me, seeing the inflation go up to 9% when it was only supposed to be 8.7 or so, and the stock market barely blinks an eye, that kind of says something that there's already a lot of bad news on inflation, on interest rates, priced into the market already.
We have another question in the chat, which is, do you anticipate moving out of Chinese investments over the long run?
No. Unless this, we'll have to see, because, well, they're about to, appoint a dictator for life, and should it really turn into Maoism 3.0, we would have to obviously not invest the same way we have been. But we'll just have to, evaluate that. Certainly the technological advances of many of the companies in China do make them attractive investments. Certainly they need to have a positive political and economic environment, and we have to stop locking down 30 million people for 2 months at a time and all of that. But I'm just going to assume that at some point, that China gets over the pandemic like the rest of the world sort of has, or at least has found a way to live with it. The political atmosphere settles down after this year, and after the new old leader is enshrined for life, can move forward with that. And then just some of the companies that are sort of cutting edge in technology, or just even serving the consumer market in mainland China, can begin to function regularly and continue with their breakthroughs in technology. And hopefully investors will be rewarded. Certainly, another couple areas I always talk about with people as sitting here in 2022, I can't imagine not wanting to be invested in them. Solar panels, no competitor to China. Battery technology, #1. Electric cars, right up there with Tesla, and with many more competitors, which is probably a good thing. And I could go on, but everybody gets the idea. But the political and economic environment around a lot of these technologies needs to be better than it is now. Reasons to be optimistic, but I wouldn't go 100% into China, but I wouldn't go 0% into them too, because of the the technology and the way the world is evolving.
We have another question, which is what American markets look promising?
Which sectors in the American market, I guess? Yeah, I'm not sure. So, I mean, everyone does, for the long run, oh, technology is the place to be. I mean, and biotech and the healthcare, that's the place to be. What's been the big problem is that they've been so expensive. As we've seen what's happened when things are super expensive and something goes wrong, like the interest rates going up, it's very vulnerable. So now with so many of the technology companies down by 25, 30, 40%, it's better than it was. Have they gotten to the point where they're, compelling values? I mean, I would say no. But that's certainly an area, should they ever really become attractively priced, great to invest in, because these are world-beating companies that dominate the American stock market. They just need to become reasonably priced.
Okay. Well, thank you all once again. Really appreciate you showing up and being here tonight. We will do this recording will be emailed out to you all probably early next week. And if you have any questions, please be sure to reach out to your team over at the family firm, and we're happy to talk more about your individual situations. So with that, I hope you all have a good evening.
Thank you, everybody.
Thank you.